If you've been watching the headlines, it feels like the geopolitical world is running on a totally new rule book. I mean, radical transactionalism.
Oh, absolutely. Just look at the moves this week alone.
Yeah, the U.S. seizing nearly $3 billion in Venezuelan crude oil. Then there's the plan to acquire Greenland, quote, one way or another.
And that's not even mentioning the ongoing pressure on Iran with renewed threats to bomb Tehran if a deal isn't reached.
And it's not just aimed at adversaries, right?
No, not at all. We're seeing new emergency tariffs slapped on key allies, Canada, Mexico, even pressure on partners in South America.
So the biggest question for you, for any professional or business leader listening, is what's the real long-term cost of this zero-sum world order?
And that's what we're going to get into today.
Right.
But here's the paradox.
The huge paradox. Despite all this volatility, this constant threat, global equity markets are unbelievably projecting robust double-digit gains for 2026.
How can that be?
How can aggression and optimism possibly coexist?
Well, it seems like the certainty of instability has just become the new normal. And geopolitically, we're seeing a massive trust deficit in the West.
The numbers on that are just wild.
Oh, you really are. Look at this. Developing nations like China, they've got 77% trust in their institutions. Indonesia's at 76%. India at 75%. They're at the top of the global trust barometers.
And you compare that to the traditional powers.
Right. Major economies like the U.S., the U.K., Japan, they're among the least trusting nations. The U.S. is clocking in at just 47%.
That's a startling data point, and we have many more surprising facts and insights coming up, so please stick with us until the end of this deep dive.
Yeah, and this is what the IMN podcast is all about. We take these complex, often really dense subjects, and we try to synthesize them into clear, simple language.
We want to give you the critical insights you need, the ones that are often missed in the day-to-day news flow. And that's why this deep dive is brought to you by IMN. It's a service designed to give you incredibly helpful, personalized information on almost any subject that's relevant to you, whether you're a professional or a business leader.
IMN searches through millions of data points from all these different global sources and just gives you the key insights succinctly.
So to cut through all that noise, you should visit myimn.com.
Okay, let's unpack this. We have to start with the immediate business impact of the America First trade agenda.
Because this isn't just diplomatic theater. This is restructuring global supply chains in real time.
It is. It's fundamentally reshaping how companies manage risk. President Trump's tariff policies have been the #1 driver of this huge market uncertainty.
And domestically, the focus seems to be shifting.
Yes, it's now squarely on price pressure, making goods more affordable. It's a direct response to high inflation and, frankly, voter anxiety over costs.
Which led to a pretty shocking, I'd say unprecedented government response to that pressure.
Absolutely. I mean, in a move we usually only see during a catastrophic economic crisis.
Right, like to prevent a total collapse.
Exactly. The administration acquired direct ownership stakes in 5 major publicly traded companies. This is pure state intervention.
To do what exactly?
To secure domestic supply chains. We're talking semiconductors, critical minerals, pharmaceuticals, steel, and national defense. The message is crystal clear. The U.S. government is now actively managing key industrial inputs.
That is just staggering. You don't see the U.S. government becoming a direct shareholder in big tech companies every day.
No, you don't. And meanwhile, the friction with our traditional allies, our neighbors, is just getting worse.
The tariffs on Canada and Mexico.
Right. The administration used a national emergency declaration to justify them. They framed it specifically as a way to increase U.S. competitiveness against our closest trading partners.
And across the Atlantic.
European exporters are getting squeezed by a double whammy. You've got the U.S. tariffs, and that's combined with the appreciation of the euro, which just makes their goods more expensive globally.
And where is that pain most visible in Europe?
Look at Italy. Their famous made-in-Italy sectors are really struggling.
The cars, the food, the fashion.
All of it. Exports to the U.S. of motor vehicles, food and beverages, and textiles, they've all seen a marked drop. This is creating real, tangible pain for Italian companies.
Okay, so this aggressive policy has also created this unexpected distortion. You called it trade deflection. What's happening there?
Trade deflection is basically the market's way of circumventing the tariff war. So, while Southeast Asian economies, the ASEAN bloc, are seeing their exports to the U.S. boom,
Right.
the underlying data suggests they might just be acting as a backdoor for Chinese exports.
How do we know that?
We see a very high correlation. Soaring Southeast Asian exports to the U.S. line up almost perfectly with surging imports from China into those same Asian nations.
Ah, so the whole China plus one strategy where companies try to diversify away from China.
That's complicated.
Because the plus one country is still just importing all the components from China. It's not solving the dependence, just rerouting it.
Precisely. It's an issue of assembly versus true manufacturing, and it creates a massive headache for policymakers trying to really cut China out of U.S. supply chains.
Okay, let's shift the lens a bit. If you play hardball on trade, what does that do to global trust, to diplomacy?
Well, the U.S. retreat from multilateralism is undeniable at this point. We've seen support diminished or even outright withdrawal from crucial soft power organizations.
And by soft power, you mean things like diplomatic influence, foreign aid.
Exactly. The World Health Organization, the World Food Program, foreign aid budgets have been explicitly cut.
And we're literally seeing an absence from the diplomatic table.
We are. The White House has opted out of sending high-level representation to major global forums, like the big climate meetings, COP30, for example.
The G20 friction is also pretty telling.
Very telling. The U.S. is set to preside over the G20 in 2026, and it's already causing friction, refusing to invite South Africa to the summit because of political disagreements. It signals that these global organizations are now just tools for political reward and punishment.
So it's a pivot to hard power. Military or economic coercion instead of cooperation.
That's the pivot.
Yeah.
We saw it with military strikes in Nigeria against alleged Islamic State targets.
Yeah.
And the emergency tariffs on Colombia we mentioned.
Yeah.
That was a clear case of using immediate economic pressure to force cooperation on U.S. mass deportation plans. It's a sort of new application of hard economic power.
So, given the U.S. is actively stepping back from its traditional leadership role, how is that reflected in that trust barometer data we mentioned earlier, especially in the developing world?
It just solidifies that massive trust deficit in the West. It's not just that the U.S. and U.K. are among the least trusting nations. It's that, conversely, high-growth developing nations, China, Indonesia, India, are showing incredibly high trust in their own institutions.
Well, which suggests the transactional model isn't really eroding domestic confidence in these rising powers.
Not in the way it seems to be in traditional Western democracies, no.
You mentioned India's trust data had some nuance.
Yes, it's interesting. While overall trust is high, around 75%, if you drill down into the numbers, low-income groups are significantly less trusting, at 65%. High-income groups are at 80%.
So what does that tell us?
It suggests that while the economic engine itself is trusted, the benefits of that growth might not be seen as being distributed evenly. That's a challenge for policymakers there.
Okay, let's talk about the fallout in Africa. When the U.S. policy is commerce over aid, but you're also using protectionism, that sounds like a perfect storm for smaller economies.
It really is. The foundation of U.S.-Africa economic ties was built on soft power tools, things like USAID, Power Africa. Those have been gutted.
And then the tariffs come in.
And then the protectionist measures hit these small, trade-reliant partners directly. A perfect case is Lesotho. Tiny economy, highly reliant on U.S. textile exports.
What happened to them?
They were initially hit with tariffs up to 50% under the new trade orders. It forced them to declare a state of disaster in their textile industry. It threatened about 12,000 jobs. And while that rate was later reduced, the signal was sent, cutting aid and imposing tariffs. It just creates a vacuum.
A vacuum that someone else will fill.
And they are. The BRICS countries, China, they are stepping right into that space with offers of infrastructure and trade, often without the same political strings attached.
And this is where all these constant global policy shifts. I mean, from surprise tariffs in Lesotho to the government buying stakes in U.S. chip makers, it creates this radical uncertainty.
It does. And for a professional, just trying to synthesize what this all means for your specific supply chain or your market access, it's a monumental task.
That radical uncertainty and the need to synthesize all this conflicting global data is exactly why the IMN podcast is brought to you by IMN.
IMN's core strength really is cutting through that information overload.
They search millions of data points from diverse global sources, from Asian economic ministries, European trade bodies, South American mining analysts, and they provide you with succinct, customized, and easy-to-read insights.
So if you're trying to navigate which tariffs apply where, or how a shift in African policy affects your raw material costs, IMN makes the complex simple and relevant for you.
If you need that clarity, you should check them out at myimn.com. That's myimn.com.
All right, let's pivot to the positive side now.
Yes. Despite all the polarization, the unpredictability, money is flowing somewhere. What's the investment outlook for 2026 that's driving all this market optimism?
The outlook is surprisingly bullish. Analysts, like those at JP Morgan, are forecasting double-digit gains for global equities.
What's behind that?
It's buttressed by a few things: lower anticipated interest rates, robust earnings projections, and of course the relentless rise of artificial intelligence.
AI seems to be the engine behind so much of this growth, but you mentioned it carries a massive risk.
It's the ultimate double-edged sword right now. We're seeing data that suggests AI is fueling a staggering 40% of U.S. GDP growth and 80% of stock market growth. But tangible, widespread productivity gains from AI across most sectors, they remain elusive.
So there's a gap between financial expectations and real-world efficiency.
A huge gap. And that is sparking fears of an asset bubble and a potential stock market crash that could wipe out a lot of consumer wealth.
So beyond the high-flying tech sector, where are smart investors looking for more resilient regions?
We're seeing bullish forecasts for equities in specific emerging markets, particularly Korea, Brazil, and India.
India seems to be a real focus area.
It is. India is forecast to see really robust foreign direct investment growth in 2026. This confidence comes from strong fundamentals, like a forecast of 7.5% private consumption growth.
And it seems like their government policies are intentionally designed to welcome that capital.
Oh, absolutely. The outlook is supported by sustained government efforts to improve the ease of doing business, decriminalize minor offenses, and importantly, usher in new investment-linked trade pacts.
It signals stability.
It signals continuity and reliability for global investors who are looking for an anchor that isn't China.
We talked about pressure on Venezuela and Colombia, but let's go south again and look at Argentina. It seems to be a very different story.
A very different story of opportunity. Argentina's economy is expected to rebound significantly, with a forecast of 3.5% GDP growth in 2026.
And what's driving that?
It's driven by strategic investments in their massive energy and mining sectors, specifically the Vaca Muerta shale deposits and their lithium reserves. And these projects are benefiting from a new policy called REGI.
REGI, what makes that such a game changer?
It guarantees tax and foreign exchange stability for 30 years on major projects.
30 years.
30 years. That stability is the key ingredient that global investors demand when they're putting money into volatile regions. And it's already helped secure over $30 billion in announced investments.
So wrapping this all up, what does this mean for you, our listener? Global business is navigating a period defined by polarization, by protectionism, and unpredictability.
Which forces massive risks, supply chain disruption, unexpected tariffs, but at the same time, it creates these huge opportunities.
Right? In areas like AI or in those resilient emerging markets that are actually offering policy certainty.
And if we zoom all the way out, I think the biggest consequence of this transactional world order is the massive strategic vacuum it's creating around global cooperation.
How do you mean?
Well, the U.S. has publicly pushed back on global climate efforts, calling them a con job and cutting its soft power. At the same time, rising powers like China and India are rejecting major regulatory moves like the EU's carbon border adjustment mechanism.
Right, CBAM, which is basically a tariff on carbon-intensive imports. They're calling it unilateral.
Exactly. Unilateral and arbitrary is the phrase they're using. So this raises a really important question for you to think about.
Okay.
In the absence of decisive U.S. leadership on climate, and with strong resistance from these rising economic powers, will the EU's carrot-and-stick approach be enough? Will things like their methane regulation, backed by funding from LNG importers like Japan and South Korea, will that be enough to compel emerging economies to prioritize global climate compliance over their own urgent development and energy needs?
A huge strategic challenge for the next decade.
It really is.
And our aim here is to make these complex subjects easy to understand, relatively short, and to give you insights that are often missed.
Because this global landscape is changing so fast, and understanding the nuances is just paramount.
This IMN podcast is brought to you by IMN. Thank you so much for tuning in to the IMN Podcast.
And remember to subscribe, follow, and share across YouTube, Instagram, Facebook, TikTok, and X.
We'll be back with another deep dive soon, but in the meantime, please visit myimn.com.